welcome back to my channel. So today's video will address one of my most frequently asked questions, and that's how do you know which strike price to choose or what's the best strike price to select? So of course everyone wants to know how do you go about selecting the right contract, and with that the objective is to select a premium with the best case scenario as the playout. So I wanted to make this video and hopefully it answers the question in totality. So y'all can see I have NVIDIA pulled up here. So the first thing I want to start with is just understanding the basic definition of how these particular contracts kind of fall into different categories. And then I'll show y'all a quick back test and we'll end the video with me showing y'all a graphic breakdown. So let's go ahead and begin. Okay, so the first thing to start with is that within options trading, at the money, in the money, and out the money describes the relationship between an option strike price and the price of the underlying stock or ETF. Now, these terms indicate the current value of an option based on where the stock or ETF's price stands relative to the option strike price. Now, this will differ in regards to calls and for puts, but the primary takeaway is that the intrinsic value of a contract is the main determining factor in the extent of profitability. So let me break this down. For call options, the intrinsic value is the current price of the underlying stock or ETF minus the strike price. Now, a call option has value intrinsically when the current price of the underlying asset is above the strike price. So this is known as in the money. On the other hand, for puts, the intrinsic value is going to be the strike price minus the current price of the underlying asset, in this case a stock or an ETF. And a put option has intrinsic value when the current price of the underlying asset is below the actual strike price. And this is also known as in the money. Now, in a second, I'll go deeper into the explanation of intrinsic and extrinsic value, but I just wanted to provide that brief overview. But just keep in mind that the total premium of an option consists of the intrinsic value, if any, and the extrinsic value, which is calculated by time and also implied volatility and other factors. So let's go ahead and start with looking at the money options. We currently see that NVIDIA is trading for $137.71. Now, an at the money option is going to be where the actual share price here is equal to the strike price. So in this case, 137 for the strike would make it exactly equal, meaning it's at the money, because the current market value is equivalent to the actual asset or stock's value. Now, one thing to keep in mind about these at the money contracts is that the option premium price is often lowered compared to in the money and out the money. Now, time decay affects the at the money options more significantly as they don't have as much intrinsic value. And again, I'll discuss that in just a second. Now, moving on, in the money options have a strike price that is below for calls and of course above for puts. Now, these options have intrinsic value and the difference is between the strike price and the current stock price as explained. But within the money options, they have more value than at the money or out the money, making them more expensive. They are generally safer if held to expiration as they already have value in the market. Now, transversely, out the money options have a strike price that is above for calls and below for puts. The thing about these options is that they have no intrinsic value. Their value comes solely from time and implied volatility. So out the money options are cheaper than in the money and at the money options, but they carry higher risk as they have no immediate value. So just to recap, at the money is going to be equal, so 137 in this case, to a 137 strike, that's at the money. For in the money options, the strike price is better than the current market price. So in this case, it will be lower for calls. So we see again, it's 137. You would go ahead and look at a 136 for the strike, and that would give you in the money. And since it's the opposite for puts, you would be looking at a 138 strike. Now, comparatively, out the money options, these have no intrinsic value to start because exercising them would not result in a financial gain immediately. So if you were to select a call option at this 138 strike, this would be out the money. And the same would also be true for puts. If you were to select the 136, this would also be out the money for puts. Now, some may ask, okay, why does this really matter? Is it a major difference? And actually it is. I will say trading in the money is the best choice oftentimes, simply because it, again, is going to allow you to have the most profitability. Now, these classifications help traders understand the current value of an option, its potential profit, and how often it can differentiate certain strategies. Now, does this mean every single time you have to trade in the money? No. If you have a specific strategy that allows you to trade at the money or out the money and it works for you, then of course that's completely fine. But I will say 9 times out of 10, in the money contracts are going to be your best friend. But it's one thing to take my word for it. So I want to go ahead and show y'all a back test so y'all can see how this would play out in real time. So I've showed y'all in one of my previous videos, in order to start backtesting within Thinkorswim, all you simply have to do is click on this on demand button here at the top right. And from here, you'll see the Think on Demand confirmation pop up. Just simply click on OK. And now I'm going to go ahead and select this particular drop down for the calendar. You guys can see it set here for January 15th. I'm going to leave it at that time as far as the date, but I'm going to go ahead and select it to be at, let's say, 8:35 for right now. We'll go ahead and select go. We wait a second for it to pop up, and there we go. Now we can currently see that NVIDIA was trading for 132 on this particular day. So I'm going to go ahead and quickly place a few trades so y'all can see how this plays out. So again, 132 is going to be the actual share price. We're going to go ahead and look at calls just for this example. I'm going to go ahead and click on ask. We're going to go ahead and put this at a market order. I'm going to go ahead and buy, let's say, 10 contracts just for example purposes. I'm going to click on confirm and send. We will send it off, and that's going to be the 132 strike. Again, that's at the money because it's actually at 132. Now I'm also going to do an in the money. So in this case, it would have to be what? Again, below for it to be a call. You have to select the number below. So below 132 is going to be 131. I'm going to go ahead and click on the ask price here. Set this to be a market order again. We'll also do 10 contracts. I'm going to go ahead and confirm and send it off. And last but not least, we'll also go ahead and do an out the money. And again, 132 is the current share price, so we need to go above for it to be out the money. I'm going to go ahead and click on this 133 strike price. You're going to see it's set for 10 again for the number of contracts. Go ahead and fulfill it at a market order, confirm and send, and send. Okay, so now we can see how this is playing out here at the bottom, but I'm actually going to go ahead and click on this monitor tab here at the top left, and we're going to go ahead and look at the positions we have. So I'm going to look at the 3 fulfilled. We'll see it here. You can also click this drop down under instrument and it'll show you exactly what you have selected. Now in this case, we can see the numbers moving. So again, the 131 is going to be the in the money. We see the 132 is at the money. The 133 is going to be out the money. So let's look and see how this P&L is going to perform based upon the numbers we see here. So we see it's pretty split even at the time, but as it continues to progress within the trading day, obviously this is a back test, so I know how it's going to play out. But you'll see progressively what the numbers do. And this top number here, this 131 call, is going to generally be the highest number as far as profitability. But I'm going to let y'all see how this plays out as we continue throughout the video. But just as quick as the market is moving, we can see already we're at a 180, and then of course it would just at 150 for this, and it's at $60 just for this out the money 133 call. So again, the profitability is going to go up and down, but you'll generally see this call number for that in the money strike price is going to be higher than all the rest. Again, it's still close because again, the market is still, moving in its motion, but the top number will be the variable that we'll pay most attention to because you'll see significantly it'll be different for the rest of these. All right, y'all can see the number difference here at the 470, 445, and 445. I'm going to go ahead and just fast forward in time, but y'all can see the clear difference between the numbers here. In the money is going to be your best option just based on profitability. So let's go ahead and fast forward. Let's go to January 17th. Around the same time, I'm going to click on go, give it a second, it'll load up, and y'all will see the differences here. Okay, so perfect. So you can see here, again, we fast forwarded to January 17th around the same time. Let's look at the profitability. So the in the money is going to be at $1,820. Well, it's going to continue to jump. The at the money is going to be the 132 call at $1,645. And then the out the money contract is the $1,495. So clearly the winner here is going to be the in the money contract. And I can tell y'all just based on experience that this is often the case. You will see in the money contracts give you the most profitability. So y'all can see the numbers for yourself. So it's not like you have to listen to my word. I do recommend conducting a few of your own back tests so you can see how these numbers play out with your own trading strategy. But again, don't take my word for it. Test it out for yourself to kind of see if it fits and it makes sense. But I can assure you 9 times out of 10, the in the money contracts are going to be way better as far as being beneficial to your P&L. All right, so I hope that makes sense. I hope everyone sees the value in what I'm saying. Again, I'm going to break this down in further detail and context. So let me go ahead and jump into the second half of the video so y'all can see this play out with visuals. Okay, so now that y'all have actually seen the proof and it was validated through those trades, I definitely want to display a visual breakdown. So as mentioned earlier, I want to provide a clear definition of the intrinsic and extrinsic value of the option contracts. So to start, we're going to go ahead and take a look at calls. So the formula will always be the current price of the stock or ETF subtract it from the strike price, and this will give you the intrinsic value. Now, it's important to note that for a call option, it has intrinsic value only when the strike price is below the underlying stock price. So this ensures that it's in the money. So a good example of this is a call option with a strike price set at $50 when the stock is actually trading at $55. Therefore, it has an intrinsic value of $5 because that's the difference between those two numbers. Now for puts, on the other hand, the formula again is going to be the strike price subtracted from the current price of the stock or ETF, and that will also give you the intrinsic value. So a put option has that value when the current strike price is above the underlying stock or ETF price, because again, that places it within the money. So using the same example, a put option with a strike price set at $50 when the stock is trading for $45 has an intrinsic value of $5 as well. Why? Because we see that the actual strike price is going to be $50, and the difference between that $45 for the actual stock price is a $5 difference, therefore giving it that intrinsic value. So the key takeaway in all of this is that the intrinsic versus the extrinsic value is the total of the premium consisting of the intrinsic value, if any, if it has any to begin with, and the extrinsic value based upon time and implied volatility, along with other different factors. However, those are the two main ones. So moving on to at the money options equate to having the strike price equal to the current market price of the stock or ETF. Now, it doesn't have to be perfectly equal. It can have the cent value kind of differentiate from the actual strike price, and that's completely fine. It still would be at the money as long as the two whole numbers are equal. Now, the good characteristics to keep in mind are that the option premium for these prices is often lowered compared to in the money and out the money options. Now, I briefly mentioned this, but I don't want to fail to have everyone fully realize that time decay, aka theta, it affects the at the money options more significantly, simply because they don't have as much intrinsic value, and y'all saw that when you seen the numbers play out. So let me go ahead and provide two quick examples. First, we're going to go ahead and take a look at Apple, for instance. Let's say the stock price is at $250, and you have a call option with a strike price of $250. This is obviously going to be at the money because the strike price and the actual stock price are equal. So I hope that makes sense. Now let's also take a look at the call example that I have on the screen on QQQ. So if QQQ is trading for $521 and the strike price is also at $521, again, just driving this in home, that's going to be at the money. So super simple, nothing difficult to understand about that. So let's go ahead and move on to in the money. Now for in the money options, again, this may be repetitive, but I want to make sure everybody fully understands that the strike price needs to be below for calls and above for puts. And again, that's in comparison to the actual stock or ETF price. Reason I'm saying this over and over again is that some people actually get this confused and think that it must be above for calls and below for puts simply because that's directionally what you're anticipating the stock or ETF to do. That's not the case. Now, these characteristics of options have intrinsic value because it's the difference between those two numbers, and these in the money options have more initial value, making them more expensive, hence why you also end up making more on the back end. And another bonus to this is that they are generally safer if held to expiration, since they already have the value in the market just to begin with. So if we were to keep in mind the same call option on Apple with a strike price of $245 when Apple is trading at $250, this is considered in the money since the strike price is below the current stock price. And then here at the bottom of the screen, you'll see that QQQ example pulled up again. So in this case, if QQQ is trading for $521 and the strike price is $520, this is considered in the money. All right, last but certainly not least is going to be out the money. Now this is just the exact opposite of in the money. So out the money options have a strike price that is above for calls and below for puts and based upon the current market value. Now, if you take nothing else away from this video, please remember that these options have no initial intrinsic value. Their value can only come from time and implied volatility. And because of that, these out the money options are cheaper than in the money and at the money options, but they also carry a higher risk as they have no immediate value. Now, I always recommend that if you are choosing to trade out the money, you should definitely have a specific strategy as to why you're choosing to do so. I'm not saying that you can't be profitable without the money contracts, but you should definitely make sure that you know exactly how this will play out in your favor. So one example that I can give y'all real quick is that if you're trading very high volatile stocks like Tesla, for example, you can actually have more profits on the side of being out the money if the actual time of trading makes sense and it's extremely volatile. Now, is this always the case? No. But for specific stocks like Tesla that offer extreme levels of volatility, especially at the start of the market, you can do a quick scalp and trade out the money and be profitable. Or you can just stick to in the money and still make gains as well. Now, going back to the call option on Apple, if there's a strike price set at $255 when Apple is trading for $250, this is considered out the money since the strike price is actually above the current stock price. And finally, the QQQ example. Again, if we were looking at QQQ trading for $521 and the strike price on a call is at $522, this is considered out the money as well. So all in all, y'all, I hope this video provided some value and that everything makes sense in order to have clarity on selecting the actual strike prices that are going to be the most beneficial to your trading. And one of the main reasons that I wanted to go in specific detail in this video is that this particular strategy and understanding these concepts can literally take a trader from making $1,000 on a trade to $5,000. Or in my case, from making $15,000 up to $19,000. So if you've never had this broken down before, hopefully it makes total sense now. So with that, that'll pretty much do it for this video. If you have any questions or comments, feel free to leave them down below. I thank y'all so much for watching, and of course, I'll see y'all in my next one.